This investor presentation shows how you can make a ton of money using the new ADU regulations in San Diego to do something like turn a single family house into more than 20 units. If we haven't met, my name is Mark Doty. I am a full-time real estate developer here in San Diego. I live in town with my wife and my 3 kids. The 2 oldest kids are on the picture on the slide deck. I've been doing projects like this one where we're using the ADU regulations to add units since 2018. And the one that I'm going through today is my 14th project overall. So with that, let's go ahead and get this thing started. I am recording the presentation and I'll send it out to everyone who registered. So you don't have to worry about taking a ton of meticulous notes. But with that, let's go ahead and start. Starting with the big idea. There are 3 ways to grow profits in a real estate business. 1 is you do more deals at a time. 2, you do bigger deals with bigger profit margins. And 3, you use more leverage. And that can be either capital or additional people on the team. That's it. Those are the 3 things that you do to grow a real estate business. On this project, I'm using 2 out of 3 of those tactics at the same time. I'm doing a slightly bigger build than I've done in the past, and I'm bringing on additional people who've got the skills to do the construction, and I'm also bringing in investors to help fund the deal. We've got a short window of time to take advantage of what's going on in the San Diego market. The ADU regulations are still relatively new, and the big competition like BlackRock or JP Morgan hasn't really come into the market yet. Interest rates are still relatively high, so a lot of our competition is sitting on the sidelines. I think as soon as the Fed starts dropping rates, competition's going to flood back into the market, and opportunities like this one to build housing in America's finest city will be gone. The problem is that in California, we need more housing, but there's nowhere to build. We've got the geographic constraints of Mexico, the Pacific Ocean, the mountains and deserts to the east, and then Camp Pendleton up north. So we really don't have a lot of room for urban sprawl. From now until 2030, San Diego needs somewhere around 110,000 new housing units in order to satisfy the demands of population growth. When this study came out, the demand was for a little over 10,000 units every year, but actual output has been closer to 4,000 or 5,000 per year. So even after everybody left California for Texas or Arizona during the pandemic, the population keeps rising and the demand for housing keeps getting worse. Because California is in this housing crisis, the state and local government have passed a ton of new regulations that allow for increased density through infill development. The regulations allow you to use existing infrastructure to increase density. They remove many of the barriers and try to streamline the approval process. The key takeaway from all these new regulations for me is that in areas that are close to public transportation or sustainable development areas is what they're called, you can build unlimited number of ADUs, which are accessory dwelling units. There's only so much you can actually build on a lot, but as long as you stay within that, there's no cap to the number of units you can divide that building space into as long as you're in a sustainable development area. All right, so what's an ADU? An ADU is a small apartment. They're less than 1,200 square feet, and they have all of their own living quarters. They have a kitchen, bathrooms, bedrooms, but they still share some of the infrastructure. The sewer, electricity, water lines are all the same ones that were built for the existing house. So if you don't have to rebuild all of the infrastructure, the idea is that you can build more housing at a lower cost. So I look at these things like mini cash machines. Even if you're building it over $300 or $350 a square foot, a 600 square foot apartment that rents it in San Diego real estate at a 5 cap, after all the holding costs and the cost of the transaction, you could build one of these things for $200,000 that's worth $350, and you can pull $100,000 in profit per unit that you build. So as a for-profit business, my goal is to build as many of these things as I can. So we're building ADUs. What are the projects that we look for? Basically, we're looking for a small house on a big flat lot. But we're looking for that lot in a multifamily zoned area so that there's other comps that are right around the same project in terms of both rent and valuation for the project as a whole. We want it near public transportation so that it falls within the transit priority area or the sustainable development area. And we're looking only within the city of San Diego because the ADU regulations are city specific, and that's the one we know the best. Our deal size is generally too small for the big boys like BlackRock or JP Morgan, but it's also a little bit bigger than your average flipper is going to take on. So we've got this sweet spot on the size of the deal that we go after. When we find one of these things and get it under contract, here's how our process works. First, we want to stabilize. We're going to rehab the existing property and then fill it with renters so that we're covering our holding costs. Stage 2 is entitlement. That's where we draw our construction plans and submit them to the City of San Diego and wait for approval. 9 to 12 months later, when those plans are approved, we'll go through a refinance process into a construction loan, and then we'll do the ground up construction. Our exit will either be a refinance or we'll sell to the next buyer. Here's a summary of the last 5 projects that I've done with different partners, but the process has always been the same. We buy the ugliest house in the block, we rehab it, we fill it with renters so it's stabilized, we take plans into the City of San Diego, get those plans approved, and then we'll do our construction. I want to make it clear that this is the first time I'm doing ground up construction, but that's why I'm hiring the general contractor who has that set of experience. In these projects, I've turned $3.3 million into assets that are worth 6.2 at the time of exit, and our average return for all of the capital that we put into the deals is about 30%, which brings us to the current project. The Ocean View project is in the 92113 zip code of Southeast San Diego. It's about 5 miles east of the Gaslamp District and Petco Park in downtown. This is a working class neighborhood with easy access to freeways and other mass transit. It has multifamily zoning and is located within the transit priority area or the new sustainable development area. This is a rundown 3-bedroom, 2-bathroom house that has an unpermitted garage conversion into a 3rd bedroom. Our plan is to rehab the house and turn that unpermitted bedroom into its own separate studio apartment and rent both units out while we're going through the entitlement process. We're probably going to furnish them and put them both on Airbnb so that we're covering all of our holding costs. And then the big picture plan is to get entitled and then build 20 to 30 units. Our proof of concept is right next door. The guy next door built 3 stories and about 14,000 square feet, which is the max of what the zoning is going to allow for us also. But he finished these units in 2020, which is right when all of the new ADU regulations were coming out. So what he did is he made these into 3-bedroom, 2-bath, 1,200 square foot condos with a garage on the bottom. And what we're going to be able to do is create the exact same amount of building space, but we're just going to dice it up into way more units because we've got the new ADU regulations on our side. So who is this deal for? This deal is for passive, accredited investors who are tired of crypto or the stock market and all of its volatility. This deal is secured by the real estate itself and has a minimum investment of $50,000. The first round of funding is going to be in October of 2023. And the first round is going to cover the cost to purchase and renovate the house and then the studio, as well as all the costs to draw up the new plans, get them entitled through the City of San Diego, and then pay for the permits. Round 1 is an 80-20 equity split with no waterfall structure. The total raise is about $700,000, and our hold period is somewhere in the 3 to 5 year range. I expect a double when we sell. The IRR, or the average annual return, should be in the range of 20 to 25%. So here's why I love this project. We got it for a great deal. We paid $570,000 for the project, and it has a ton of upside. It's on that big flat lot with multifamily zoning. It's right next to the bus stop, so it's in the transit priority area. And what I really love about it is that the proof of concept is right next door. Our plan is to spend the first year stabilizing the house and converting that garage into the studio. While we're doing that, we'll get our plans drawn up for the ground up construction, get that plan approved by the city, and then we'll pay all the fees and get that fully entitled so that we're ready to begin construction. Once the plans are approved, I'll raise the second round of funding and we'll refinance into a construction loan. Ground up construction should take 12 to 18 months, and depending on how the market looks, at the end of construction, we'll have the option to fill it with renters or just sell it to the next buyer. All in all, the project should last between 3 and 5 years. There are a handful of assumptions that we made when we put these projections together, so I'll just kind of read them off here. First of all, we are looking at a 5% market cap in San Diego. We expect 3% annual rent growth. Vertical construction can cost a range between $300 and $350 per square foot. Our construction timeline is about 1.5 years. The hold period overall for the project, there's going to be a range of 3 to 5 years, but we're going to see continued unmet demand for housing in San Diego. And we think how the market looks at the end of the project is really going to dictate whether we refinance and hold for a few more years or if we sell it right away when we're done with the construction. There's no waterfall built into the payment here. And then if you look at the rent rolls, these are smaller units. The studio is 275 square feet, and then the 2 bedrooms are about 500 square feet. That can all change a little bit as we go through entitlement, but the units are on the smaller side. And if you're comparing the rental rates that we have to, most of the other places in the country, these look outrageous. But if you're in San Diego and you're looking for a 1 or 2 bedroom, these are all lower than the median price point for rent in San Diego. So this is a conservative estimate. We've got some assumptions built in there, but overall, this is what we're projecting for a rent roll. When we add up the rent roll and factor in expenses at 33 to 35%, we have a projected gross scheduled income of $560,000, which seems, again, very reasonable. If we do that at a 5 cap, our valuation is going to be in the $7 to $8 million range, and that's also using today's market rent. It does not include the 3% rent growth that we expect to see over the next 5 years. These next 2 slides break down where the funding is coming from and what we intend to spend it on. There are 2 rounds of funding in this project. The first round, which opens up in October, is to fund the purchase of the house, the rehab of the entire floor plan, the conversion of the garage, and then the entitlement of the new units that we intend to build. We're going to design all the drawings, get the engineering plans done, and pay all the fees so that we've got a stamped approved project ready to go for round 2. This part of the project should take a year to a year and a half. In the first round, I'm raising $650,000, and it'll handle everything to get to that stamped approval. The equity split is a little bit bigger for the people who go into the first round of funding. And the reason for that is there's more risk because we don't know exactly what's going to get approved. And until we have a stamped plan, you can't move forward with it. And then the second round of the funding will cover the delta between what the bank will fund for the construction loan and what the general contractor is going to end up charging. I expect that to be up to $2 million, but it really depends on how many units we get approved and what the floor plans look like. And in total, with everything all in, the project should cost about $6 million. I'm not charging any acquisitions fees or property management type fees on this one, but I am charging a development fee of 8% of the total cost of the project. And the way that I'm paying that out is on four milestones. So the first milestone is to get the plans submitted to the city. The second one is when those plans are approved by the city. Then the third milestone is when construction begins, and the final one is when construction is all done. I have my own money invested in this project, and if it's not moving forward through these milestones, I'm not going to make any money on the project either. We're basing the valuation on a 5 cap, but there's also a little bit of wiggle room on the cap rate, so we've got a couple of bumpers around that as well. The key piece to focus on in the pro forma is how rent growth impacts the value over time. 3% rent growth doesn't sound like much, but by holding and allowing for that increase over time, it's a huge impact on the project's returns. Yes, there's government interference and tenants have rights in California, but a side effect of that is that you have to build in small rent increases every year because you aren't allowed to do it like once every 3 years and have a bigger pop at a time. So you've got to have incremental increases every time a lease renews. So with that in mind, when the project is built in 5 years with 23 units, the value could be touching up to $9 million. Here's the path that a $100,000 investment will take over the course of the 5 years of the project. On development projects, there are very marginal returns until the end when we sell the project. So if you're looking for a higher cash-on-cash type of return or monthly or regular income, this is probably not the project for you. However, if you hold through the entitlement and are able to wait for the 18 to 24 months for construction after that, it will start to generate a little bit of cash flow, and then it should double your money around the 5-year mark when we sell. This last slide has a little bit more information about me and the team I put together. But as far as the investment, I'm opening the first round of the offering in October, and I've already got a ton of interest, so it's not going to be open for very long. It's an awesome project, and if it's something that you want to get involved with, all of my contact information is listed here. Reach out, let's schedule a call, and you can ask any kind of questions that you have. With that is the end of the presentation. I'm going to stop the recording, but I will open it up for questions.